Now on Sky News Business, this is Trading Day, live.
Well, good afternoon to you. We are just past 2 p.m. in Sydney, 2 hours until the close of this session in Sydney. This is Trading Day, and what a day it has been. The equity sell-off continues with the S&P ASX 200 down by pretty close to 3%, extending its losses. In the last two sessions, 4 months of gains, or over $50 billion, have been wiped off the local market. All industry groups are down. We've got Infotech off by 4.5%. So tech and energy as well, the worst performers. Energy shedding almost 4% as we head toward the close. Let's check in on what the situation is like across the region. Well, the Nikkei 225 could be entering a correction, down by 5%. The last couple sessions, it's lost more than 7%. Stocks in Hong Kong also down 4.5%, pretty close to it today after closing 1% lower yesterday. And Seoul's Kospi also lower, off by about 3%. Down by about 4% over the week. Now, we're watching in on the volatility index as well. It is up, and that's no big surprise. Check it out. It's up by more than 115%. Now, in and amongst all of that, there is company news this hour. Magellan Financial shares sinking to their lowest since November after the fund manager posted a 39% drop in its 6-month profit. And in just about 30 minutes, we'll be hearing from the RBA as it wraps up its first monetary policy meeting of the year. We'll bring you live coverage from the central bank. So do stay tuned for that. So it is 2 hours left in the session, as I mentioned, and counting down to the RBA's first interest rate decision. We'll keep you abreast of all the breaking market moves at the bottom of your screen. Let's just set the scene, though. Let's get across that U.S. market plunge, which continues to impact this Asian trade. U.S. stocks plunged in highly volatile trading on Monday. The Dow Jones Industrials falling nearly 1,600 points in the session, the biggest intraday decline in history. The S&P 500 ending 7.8% down from its record high on January the 26th. Now, before Monday's fall, put this in perspective, the index had not seen a pullback of over 5% for more than 400 sessions. That's the longest such streak in history. Now, the closely followed fear index, that volatility index, which we were just showing you, jumped 20 points to 30.71 in U.S. trade. So that's the highest level since August of 2015. U.S. dropped over 1,000 points. So that's the Dow in the U.S. before bouncing 800. And that all took place in the space of 15 minutes. So volatility, well, you think, and the volatility is continuing in this Asian session, with the S&P 500 E-mini futures now down by 1.6%. So we had seen these lift when trading got underway here in Australia, but it has been a sell-off happening throughout this Asian session. Now, flick onto metals now to see where the money is moving into. We did have gold and copper higher, opening in London higher. Worthwhile mentioning that Citigroup released a note today really recommending that fund managers boost their exposure to industrial metals such as copper and zinc. Let's get some perspective on this market. Chris Conway from the Australian Stock Report is joining us live from our Melbourne studio to give us his view on this rout. Now, Chris, welcome to the program on what's a pretty active day around the region, has to be said. We had Ray Dalio writing on LinkedIn that he sees the market declines we're seeing as just, quote, minor corrections. How are you viewing the action?
Good afternoon, Nadine. Look, obviously it's not a good day. You've just been through the shopping list of records and various statistics that highlight just how bad this session is. But look, I sort of tend to agree that we get caught up. It was only a couple of sessions ago that we were talking about this melt-up in the US and everything was rosy and the bulls were in control and we're going to keep on running. We've had 2 bad sessions. We've had the worst point drop on the Dow ever, which I think is an absolute misnomer, and I'll tell you why. Firstly, because in terms of a percentage drop, the 4.6% that the Dow finished down last night doesn't even crack the top 20. And barely makes it into the top 100 point declines on the Dow. So you see the headlines screaming across everything this morning, biggest point drop in history. We just need to provide some context. So don't get me wrong, it's not good. And it's almost, as a few other people on the show have been saying this morning, it's the correction that we had to have because we had such a strong run preceding it. But I don't think it's time to panic.
Well, if it's not time to panic, what is it time to do out there in this market? I mean, you've got to think that it's a brave soul that goes in and buys in any big way. We haven't seen, likewise, the big money, the smart money, the big funds selling out of this market. So what's current strategy?
Look, I'll just talk from my perspective as a trader. So I'm waiting for the market to find some support. I'm hoping for the Australian markets that it is at around current levels, around 5,800 to 5,830, because that, of course, was the cap of that sideways period that dominated market action for so long last year, and of course we struggled to break out of. So we've come back to the top of that range now. I'd really love to see us hold here. Probably we won't. We probably, in all likelihood, will go a little bit lower. But as a trader, like I said, I'm looking for the market to find some support, and once it does, then I'm searching around for stocks that I wanted to buy previously that were overvalued, but are now representing far better value given the sell-off.
Yeah, I heard somebody else reference it that stocks essentially today are on sale.
Yep.
What sectors are you looking at, or are you agnostic and you're just looking not on a sector or index level, but more specifically at certain names? Give us one.
So BHP is one that springs to mind, and I'd been on the show a couple of weeks ago saying I'd love to get another opportunity to buy it down at sort of 28, 28.50. Of course, it was well north of 30 at that stage. Today is a day where it slips back below 30. And again, if we get a little bit of further weakness throughout the week, that sort of falls into a price range where previously I would have been happy to buy it. We forget these things. I said that 2 weeks ago. I might be presented with that opportunity. I need to remember that I said that, and a few other people out there need to remember the things that they said 2 weeks ago, because the fundamentals haven't changed. Sure, we have rising bond yields in the US, and that's what's really causing the concern. But a layer removed from that, that's because we have a very strong US economy, or a vastly improving US economy. So, we give it up a bit now, but if we get a stronger US economy, we get this synchronized global growth upswing to continue. There's some positives behind what we're experiencing right now that will mean a BHP after, sort of a 5% decline probably offers some value.
But when do you start to get concerned? I mean, a lot of analysts out there saying that it's actually the computers that are exacerbating the declines, the extent of the declines and the sharp volatile moves that we've seen. But I mean, if we continue to see day after day after selling, when does that become a sentiment killer?
Well, just to that first point about whether it's computers or whether it's humans, I don't think that's relevant at all, because we're the ones that program the computers. So I don't know why any analysts are pointing to that as a point of relief. Look, I think you just pivot back to the old norm. So 10% is a correction, 20% is a bear market. I really don't think we get towards a bear market. I don't think the market was 20% overvalued. So I don't think we need to get to see a 20% sell-off where the market is at fair value. And again, against the backdrop of an improving global economy, I just don't think we get there. I don't know where that middle ground is. Certainly sentiment will probably take us further than what we need to go. But there will be a tipping point where people look at it and say, things have just gotten too cheap. The economy is still good. The global economy is still growing. And, we've got the pullback that we wanted, and now we need to jump back in.
We've also had some company news. Lost in all of this, we are in the midst of reporting season, and we had half-yearly profits coming in from Magellan Financial Group, actually down. The company recording a 25% uptick, though, to underlying profit after tax. It's a 39% drop in its half-yearly profit after tax to $53.5 million. The company signaling that funds under management grew significantly, up by about 25%, now sitting at $53.6 billion. I'm curious to get your thoughts on two of the strategic acquisitions that are being flagged by Magellan: Frontier Partners in the US and Airlie Funds Management here in Australia. Chris Conway from the Australian Stock Report, what did you make of the results? But more importantly, what do you make of some of these strategic moves that Magellan is making?
So firstly to the results, look, I thought the two things that stood out to me was the 15% increase in dividend payout and the 109 million NPAT, which was in line with the expectations. So, sort of right on the money in terms of what the market expected. The sell-off today, we sort of need to put that to one side a little bit. The big news for me was the acquisition of Airlie Funds Management, which of course is an Australian based fund manager and focuses on Australian markets, whereas Magellan has usually been a global fund manager, wanted to stay outside of Australia. So that was an interesting acquisition, but when you look at what's behind it, I think it was Early that approached Magellan last year, and it sort of makes sense. You know, Early was traditionally an institutional fund manager, so it only focused on institutional clients, and really needed, you know, the retail arm which Magellan has in being able to grow its business. So it's a tie-up that sort of makes sense. It increases Magellan's funds under management to the tune of about $6 billion. So, you know, there's probably enough synergies there to make it worthwhile. It'll just be interesting to see how it plays out in the future, because as I said, it is a departure from Magellan's traditional formula where they're focused solely on international markets.
We also heard from Macquarie today forecasting a 10% rise in full-year profit. Now that's on the back of strong performance fees from its asset management unit. The bank says that trading conditions across the board were satisfactory in the December quarter. Full-year net profit tipped to come in at a record $2.2 billion, and it comes after trading businesses fell last quarter due to the timing of the income recognition in its commodities division. So it certainly looks like Macquarie, Chris Conway, is going from strength to strength, and also still signs of strength in its, you know, its infrastructure business as well. So is there any sort of headwinds that you can see facing the bank right now? Does this current bout of market volatility change the picture at all?
No, I wouldn't have thought so. I think if debt becomes more expensive, that might move the needle with regards to Macquarie's infrastructure and asset management businesses. But look, the trading up to date today was really an extension of what Macquarie has done for the past 10 years. So, you know, it used to be that their capital markets facing business was the bigger generator of both revenue and profit. That has totally swung around. Now it's their infrastructure and asset management business that equates for about 75% of profit. That was the segment that had the stronger December quarter, whereas the capital markets facing business continued to retreat a little bit. I think this is a really strong set of numbers for Macquarie, not only because of the 10% uplift in guidance, but because there was a period last year where some analysts were starting to question whether the infrastructure and asset fund management business could continue at the rate that it had. And that was because asset prices were becoming more expensive, because there was more competition in the space of people wanting to try and replicate the Macquarie model. So it shows that there's a lot of life left in that model, and, you know, really positive for Macquarie shareholders. In terms of headwinds, can't see too many on the horizon.
All right, Chris Conway, we'll leave it there. Thank you so much for joining us. Appreciate your time as always.
Thanks, Nadine. Cheers.
So if we take a look at what's happening out there in the market right now, the S&P ASX 200 is continuing to trade well into the red, down by about 3%. 58.44 is the level there, and we're watching oil prices sinking more than 1%. So that's really putting pressure on the energy space as well, which is still the worst performer. Worthwhile noting, though, that some of the big miners are actually outperforming the broader market, and that would be Rio Tinto, which is off by about 0.5%, and Fortescue, which is off by about 0.4%. We're watching a little bit of a lift coming through in Dalian iron ore futures in this Asian session, which, safe to say, otherwise is nearly a complete sea of red out there. Northern Star Resources, another one of those Australian companies that is seeing a bit of green on the screen. That, of course, in the gold space.